There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Without further ado, my name is Steve Vettel. Today is the 13th of November. We are cruising through Q4. And there's lots of all kinds of craziness in central bank land, so I'll try and outline a little bit of that. I've actually done some pretty decent research this morning, something I really can't say I've done a ton of the last couple of months. And I'm going to go through kind of what our view here is. We're getting ready to write our Q4 piece for clients. I thought I'd give you guys a little bit of insight into what we're doing as far as looking at global economy, financial markets, central banks, interest rates, inflation, all that crazy stuff. But as always make sure that you go into your group. And by the way, somebody type in, if you could, please, if you can hear me okay, see the screen okay, should be looking at the AP social screen. I subscribe to all these groups just so I can monitor what's going on and or for my own personal trading systems. The variable community looks like they have a fix. It's coming from Dasan for looks like some errors here going on. So if you guys are involved with the variable, which at some point I'd be involved with all if you could afford it, is a fix coming. So just keep that in mind. It's sort of something that's popped up, I guess, last few days. I don't know that it affects a large swath of our subscribers, but just keep a note on that. Let's take a look at the calendar. Not much next week. Keep in mind, in the U.S., we are coming into the holiday season. So we are forced to watch lots of terrible holiday commercials that make you just feel like you're a complete loser, right? So as I always say, don't pay attention to the television and social media, and don't let it turn you into a basket case. The Forex Factory for next week will be interesting to note with some of the CPI coming out. You guys could see the forecasts versus the actuals been higher. You know, always good, I think, maybe a little bit outside of what we normally would do in terms of research. But look how these actual forecasts have been coming in higher. So personally, I think that transitory inflation discussion, which is being echoed by many central banks right now, is it's what's called a smoke bomb. So we'll talk a little about that as well, but I don't really see anything going on that's going to really stand in the way of any crazy trading. But, you know, it still boils down to, I don't really want to trade in front of any red folder event, right? I don't care how small or how strong of weight it carries in terms of markets. Something could always fly out of any of these news stories to disrupt any of the different markets out there right now. We're obviously concerned a little more about currencies and equity indexes, as most of our subscribers trade those, but you want to know kind of how this affects everything. So I try to keep it real macro and real basic. That's essentially it for the calendar. So Peter Bachvar is probably my newest bromance. So I'm always looking for people that can cut through the crap and just give it to us straight, no bias, right? Always have that risk management tinge to everything that they present. I mean, that Peter's really, I've been turned on to this guy a lot recently. He is very good friends with Ryra Harris, who I view as one of the smarter guys in central bank macro land. It comes from, you know, a deep bench as a trader on the floor of the exchanges over the last 30 years. And he's moved into more of like but this guy has a blog that has a huge following among big traders out there. It's called the Notes from the Underground. You can Google it. But one of his good buddies is Peter, and these guys do podcasts together. And I usually take a lot of notes from these podcasts because it just helps me cut through sifting through all this crap at the end of the week, right? So I think what I'm going to probably do in the future is I'm going to pull, just because I think it's good. And if you guys want a link to this, let me just paste this link for you. Just keep in mind, these comments have nothing to do with Auvoria Prime. They have nothing to do with me, but it is a good summary. Okay. And I posted the wrong notes. So let's post the link. Posted my weekend notes, huh? So all right, so disregard that previous post. You know, one thing I just noticed, you guys can't delete anything in the posts. Isn't that crazy? So I can't go in and delete it. All right. We're learning something new every day. So the weekend's events, there's positives components to this. There's negatives. I mean, you can go on and read all this stuff. I'm not going to roll through all this, but I thought the initial jobless claims was interesting, this first point. Do keep in mind mortgage rates, and this is something we're talking about as far as formulating some of our Q4 summary opinions. We're going to try and get in the habit of. I've been very sporadic about this the last few years for clients, but I'm really going to try and get in the habit, especially since there is a ton of eyes on our new startup First Down, and doing a quarterly report for clients. So keep you guys plugged in on that. But this is interesting. There's like 10.5 million job openings. I mean, that's just bananas amount of demand as far as unfilled positions. And this definitely adds to that, hey, we need help, supply chain, this and that, right? Consumer expectations. This is the German Zoo. I think this is important. Always pay attention to these reports. So more confidence, obviously, as we come out of the pandemic. Of note, as much as we can't stand China at this company, I don't want to overlook any of the numbers that they ever have coming out, right? It's always important to follow from a currency standpoint if exports are rising. And keep in mind, as as Japan's currency has weakened in relation to a lot of currencies because of the fact that they've been bringing so much energy into Japan because they've had to shut Fukushima down, as you guys may have heard about that. If you haven't, just Google it. It's a big old meltdown, which is really unfortunate because it just continues to fuel the disregard for probably one of the best sources of energy out there. It's like they crash a car in energy, or I should say they crash a car in nuclear, and they won't fix the car and try and re-engineer the car, but they know that the car is the best small source of transportation, right? Maybe not the best analogy, but it's just amazing how if they just actually put some time into really getting it dialed in like some countries have, it could power damn near the whole country, which would completely reduce, again, risk management, right? Completely reduce your reliance on outside energy to be brought into your country. So negatives, continuing claims, CPI, obviously it's all related to inflation, right? PPI, October Fed. Now I thought this was interesting. So and I think was it 10 points? Yeah, here it is. There's actually a chart that goes with this, but the fact that, I think this is it right here. Yeah. Basically, maybe I should have put the chart up on this. There was a huge University of Michigan Consumer Confidence Index, and this is the generic one that they print all the time, but they actually break it down by sector, and the Consumer Confidence Index for auto purchases actually just dove to like some of the lowest levels. I'll see if I can find the chart for you, but and basically went from like the 160s down to 50, which is a huge drop. And what that basically tells you is that consumers' confidence in vehicle prices, or their willingness to part ways with money to purchase a vehicle, it's just absolutely fallen off the planet. I mean, they haven't seen a drop like this, and maybe that's a good thing, right? Maybe all these dealers, both new and used, and certainly to a lesser degree the energy space that powers these types um, of machines, will see that there's no interest in buying right now. I mean, there's obviously low supply, there's low inventory, but the prices are also high. So I thought that was an interesting sort of sub note. But you guys can go through these. Not going to get too much detail into it. I think there's there's probably a lot more detail in there than somebody should read into it. But you can just scan through looking for some of this. You could do the same thing with news stories and all, but I'd rather have somebody that could just help me cut through the crap. So let's take a look at the charts. So, and actually, you know what? Tell you what, before I do that, just hang tight on the S&P. I'm actually going to go through some of these notes and see if everything I mentioned. So I'm just getting, this is a draft, but I'll just kind of read this to you guys. So our current view on the global economy and the financial markets, essentially at a real high level. So right now we're in a situation where inflation's is proving to be more persistent and sustainable rather than transitory. So I've been talking about that for 6 months. It's a broken record, but it really has been playing out. And we're seeing now that there's a lot of factors causing inflation, and then there's a lot of areas where there is no inflation. So I'm not really trying to apply it's only supply driven, but a lot of these supply driven issues now are showing up in the economy and in inflation itself in terms of consumer reactions, right? So slowing demand as well as inflation is running faster than consumer spending. So real spending is actually down in the third quarter. I've talked a little about that in the previous comment. So if you listen to the Atlanta Fed, which is one of the few I actually pay attention to, their estimates, they're expecting to essentially be zero and no growth, when their estimate was 6% just a few months ago. So rising inflation, that's cutting into real GDP, and it's creating an interesting situation for world central banks where, at least from the Fed's perspective, you know that they'll start next week by announcing that they're going to be trimming asset purchases, right? And that should take them into the summer of 22. If you've been paying attention to any of the comments from Yellen, who is our Treasury Secretary, or certainly Jerome Powell, our chair, they've been talking about this a lot. It's all completely priced in the market. Not to say that there's not any risk management associated with that, but I think it's mostly sort of priced in the market. But before they even get around to discussing, whether they're going to get rates off the zero spot, it's an interesting where you have essentially global stock markets, at least the developed ones, are at or near all-time highs. We certainly are the case here in the U.S. And we're about to get a Fed tightening, and not just Fed, but a global monetary tightening among other central banks. So, like I said before, the inflation being sort of the sticky point, starting to cut into corporate profit margins. So that could affect earnings, obviously, into the next couple of quarters. So depending on what extent that these corporations can pass it on, it's just an interesting thing. And I think myself included, I was a young child in the early 70s, and that was the time, at least in this country, where we really had just out of control inflation. Monetary policy was much, much different in the 70s, especially the early part. But probably some people recall seeing like long lines of people waiting for gas, and just the prices of everything going way up. So what the Volcker and some of the early Fed governors back then, they actually cut a lot of that inflation out by just lifting up rates, and then rates coming into the 90s, as many people know, were ridiculously high. So, the 30-year Treasury bond was paying over 15% at the high, which is almost unfathomable, right? So the problem that I'm seeing, I talk a little more in detail about this in the report we're writing, is that it's difficult to listen to anybody in the financial media because there's so many smoke bombs being thrown out there. Okay, just trying to mask what's going on. I have a very big real estate client. Guys owns just some tremendous real estate worth over 50 million, and he can't understand. Some of the smarter people I know, a lot far smarter than I, in the real estate market, and he's just really confused. And quite frankly, so are we. So I mean, everybody's got, we have an environment where the dollar's rallying, gold broke out, but yet mortgage rates are falling to some of the lows that I'd mentioned back in some of Peter's notes there. I mean, it just doesn't make sense. So, I mean, from the standpoint of somebody, if I actually was on a credit desk trading bonds for a fund or myself or wherever, right, I'd be really confused, and that's not a good thing to be if you're a portfolio manager. You got to be plugged in of how this is affecting. And I got a couple of dings this week from AP subscribers basically saying, "Hey, Steve, you were dead right in the dollars move. Good job." I don't really necessarily think it was any of my prophecy coming to play. It's just look at the charts playing out, right? I mean, the damn thing was coiling, was up against a huge, strong area, and I should probably talk about this while I have the stupid chart up, huh? And it just absolutely ripped, which I fully expected to happen. I think we got further to run, but looks like we may pause here for a bit. I could be wrong, but we came up against this area so much, and this chart didn't look like the chart of gold, but it did look like just an area where we kept coming up against the ceiling like we saw in gold this week, and then they both just absolutely blew through it, and then rates dropped in bond land, right? So you could see how it was almost an inverse reaction with these two. Maybe not the easiest to see, but normally this makes sense. But with all the smoke bombs, and that's our theme of Q4, we're just going to call it the smoke bomb. Everybody's trying to throw up just ways to cloud, and we need corrections in equity markets. We need stabilizations in some areas. Currencies have been quite wild, but the fact that there is just global uncorrelated movements generally, right, just makes it really hard to see through the smoke. And so thus, some of the comments that you're seeing out of a lot of people, at least that I follow, and so forth. So I don't want to drag it on any more than I just kind of want to give you guys some deep thoughts. If you guys ever seen all those old SNLs, they were great. Saturday Night Live's Deep Thoughts by Jack Handy. Anyway, DXY. What more can I say? Let's go to the weekly chart on this. I can give some perspective. So we're back up in missing notch land, right? That'll be my comment on this. We're back up in missing notch land, which is really just a comment of, if you were to look at a profile of volume just for this single candle where we had this COVID-based move below a very long-term line that turned into total resistance. We blew through it. Does it mean we're going to hold above it? I don't know. I think we've got some time to spend sideways trading above this, but I'm pretty sure we're going to see the high 95s pretty quick. So I'm just unwilling to step in front of that from the perspective of the dollar. So let that play out as the opposite of what you do, as center of the euro, right? I just am unwilling to buy this drop. So if I was a swing trader and you see that it finally broke an area we've been talking about way too much, you want to ride the coattails of the drop, right? So any rallies typically are shortable, right? Short the rips, right? Not buy the dips in this particular case. DXY obviously opposite, even though this is not 100% correlated with the euro US dollar. 70% of this price action is euro yen movement. So let's flip that on its head. Take a look. So I'm just looking at the weeklies, right? I'm trying to get a lot of noise out and give you guys just more of a broader view than getting into the minutia of what I would do right now. GBP, same thing. We're holding the line, right? There's a lot of naysayers out there, as many may recall, I've been talking about over the last number of years, that didn't think they could get it done in the Brexit area. I always had faith, but the currency will eventually tell the long-term story. But it's probably going to be very hard to hold this area if the dollar keeps rallying. I would expect this to drop further lower. There's another energy-dependent country, right? This is the opposite story of what's been happening, at least since May, of right pre-pandemic levels here, essentially Q1 of 20, and it's been just dropping further. If you take a look at the daily on this one, we're still inside the zone. You take trades both ways, in my opinion. Dollar yen, tight sideways. Not going to go into that too much. I did want to mention, since we were fresh on the gold story, I talked about how we would be looking to take this on a breakout. You had from the perspective, not necessarily the spot, but if you look at the GLD, see how volume really picked up. See how it was sort of stagnant, and then we traded Doji daily chart. Yeah, this is the very actively traded GLD, which is essentially the Spider's Gold Trust. I like to analyze this from a volume perspective, because this is really heavily traded. So that was an 11.5 million share day right there, and that's probably catching a lot of shorts off guard that were long-term short this. They got barbecued on this gap up, but a lot of this is dollar related, sort of pin action. But these guys have been moving in tandem, our dollar and the price. But again, outside of all that, it really just boils down to price action. We spent a lot of time balancing, building a sideways trade, and then we got above the areas. Notice that perfectly aligned, at least for this data set, which you really only want to look at the ones that are I mean, look at how perfectly this was the value area high. Not crazy. So it's almost like you want to take the breakout of the value area high. Been talking a lot about this. If you guys have missed some of this, you can watch some of the previous Saturday recordings. I've gone into exhaustive detail of how to use market profile from a volume perspective to see the breakouts coming in, or see the value areas where you could spend a lot of time just sort of balancing on a sideways or a sideways trending type of trade. What I haven't done, and do not still have the ability to do in TradingView, is a price based analysis on time, right? That's what I keep bitching to get these guys to do, but requires a whole other set of Pine script coding to get that done. Somebody, I imagine, is probably going to get sick of me and a whole bunch of other people talking about we want market profile from the perspective of time. Now we can overlay time with volume, and we have two huge data sets to work from that just continue to solidify areas of resistance and support, right? It's all it really is. It's just another way of looking at the technical analysis in this area. So we can always look at pricing, action, and candles, moving averages, and Bollinger Bands, and all that, right? And then I have this empirical suite stuff at the bottom, which is just a much more complex view of a power of a trend, right? But in the end, that is like, it's almost like the other side of the tracks of technical analysis. Whereas if you jump over to the other side of the tracks, there's other pieces that are much, much more important in institutional trading land, like market profile, right? From both volume and time perspective, like DeMark indicators, right? which is just a very sophisticated algo that hunts through the market, like McClellan oscillators, right? These are two tools that I use in addition to market profile that just help determine, mostly algorithmic based. Many of them have over 10 factors they look at for the numbers that they print. So I have those a lot on my other systems. But in terms of just looking at technical analysis, one doesn't necessarily need the other side of the tracks indicators to make money, right? I mean, look how simple arrow is. Bounce, arrow, go. It's great, right? And there's other factors. Obviously, there's lots of strategies with arrow as well. But those guys have been doing good. So they're going to continue to get better. But, they're doing that off of a lot less technical analysis than I hang on, right? So, what else? I'm going to start from the bottom up. GBP NZD, daily. We're just looking at dailies at this point. Broke lower. Really seeing a tremendous rally attempt. AUD NZD, keep on, we're just rolling through daily charts right now. AUD CAD, long term, still stuck in a, and these are two energy heavy countries from natural resource perspective. GBP JPY, interesting that we're back inside the balance area. Swiss, GBP CAD, this is the NEO. Notice we've got some squeeze zone lines that are appearing, or support and resistance lines that just showed up. So we may be continuing to sideways trade, which maybe bodes well for the software if it's going to be taking both sides of this trade. Euro JPY, we're back inside. Thought we were going to break out. I was wrong. Euro GBP, a long time stuck in a very tight trend. As the currency just doesn't move that much. Weekly on this show kind of the same story. Let's see how tight we've been. Much tighter ranges than we have seen in the past. What does that typically portend? Is possibly a breakout of trend. CAN JPY. Let's go back to the daily. Wanted to look at the Aussie here as well. And jump back to this GBP CAD. So this one spot 771's like the 70, like the 7100 area here. This is the volume point of control. Anytime it shows up with that red line in any of my charts, that's the center point of where all volume traded over just the time period you're looking at on the screen. So if you just drop back, it'll show you the date. In this case, it's the 8th of February this year, all the way to now. So coming up on what, 10 months, right? So 11 months, something like that. Collects all the volume over that period of time and puts a logarithmic on a bell curve type scale. So that's essentially, and you guys, I've actually put some pretty decent notes up on AP Live. You can see if you want, like, sort of like the primer on market profile. It's pretty cool. Quite effective, because if you look at, let's say you're trading long term in a big portfolio, right? Look how this is absolutely contained, along with a whole bunch of other areas of confluence, as contained once we broke below it in September. We just continue to come up against it. There's no interest from the standpoint of someone looking to buy the pound in relation to the Canadian dollar. I mean, obviously, some of this is natural resource related, and some of this is Brexit related from the pound standpoint. I have not. I always like listening to Fernando's analysis on this. I haven't had much of a chance to listen to his calls. I don't know if he's echoing the same stuff that I'm talking about, but it's worth noting. Always taking different opinions. He's a good guy. Very involved too, I might add. I know that we have varying degrees of involvement from our developers, but he is damn near at the top of the list in terms of the community. What else? CAD Swiss. Man, this thing has just been such a tight range. What else? That's pretty much it. Oil, just for reference purposes, we pulled back probably about $4 from the high. Gasoline's actually pulled back more. Notice I'm not talking about Tesla. So let's go to the coinage, where I've probably just basically been wrong. Hard to stand in front of the mania, right? I mean, it's the same story as Tesla and a whole bunch of other stocks like Nvidia. Ones that have just been rocketing up. The mania takes front and center stage. So from the standpoint of risk management, it's hard to argue against that stuff, right? At some point, the music stops, and the key is determining how many chairs there are left to sit on. That's what's most difficult to determine in a lot of these mania stories. But for now, it's looking like the next path of this is 100K. Doesn't mean I'd buy it in any pullbacks. I possibly would have been a buyer here, and I guess at some point I can always look back and say, well, coulda, woulda, shoulda. But the difference is I just don't have that built in my mindset. I actually don't care if I miss big runs. I've missed most of Tesla's big run, probably a good 3/4 of it. I don't give a shit because there's plenty of other opportunities out there that offer the same types of returns with significantly less risk, like Nvidia, right? Which is overpriced now. So talk for hours on this stuff. Of note, some of these others, not Ethereum, which keeps making new highs along with the coinage. But this right here, for the question I just got on this last time, I probably look at a 4-hour chart. This is the ProShares, because they're a big mutual fund ETF company in the U.S. Actually, they're a good group of guys. This is their new Bitcoin ETF. So this particular data comes from ARCA, which is one of NYSE's companies, provides the data. And we don't have much data. So, we're basically looking at a 4-hour cut of the last 3 or 4 days that I showed you on that previous coinage chart. But it's, we'll be able to look at this more and more. We'll be able to have volume. And right now we've got not much. And what? That's actually pretty good. Stand corrected. So the first 2 days, geez, 24 million, 29 million shares traded this thing. This is strictly Bitcoin futures. Okay, that's what this portfolio holds. You'd have to read the prospectus, probably 100 pages long, to try and figure that out. But it just holds futures, which are traded on the CME. It does not hold actual Bitcoin. So just keep that in mind. This is not a solicitation to purchase this, but it is a different way for us to analyze the movement of the coinage from the perspective of an ETF. So it's along the same lines as to why I'll analyze both spot gold and dollar as well as the GLD, right? Or I'll look at the spiders, which I don't really talk too much about, in relation to the SPX, right? Because this is one of the most liquid markets in terms of an individual issue on the planet. So it's very accurate in terms of the data that's coming in for this. And this is traded on many different exchanges, but we're getting the data in terms of volume from ARCA. Important to note, if you're really getting into more of the market profile, you want to make sure you have quality and solid, unerror-based data coming in. So one of the advantages, which I'm probably seems like I own shares in Linsoft, but my market profile software I use in my other systems, which I've shown a couple of screenshots of here on this from time to time. It has a very cool feature inside. It'll allow you to what's called scrub data. So I can actually go down. This is where it takes some pretty serious computing power in your CPU, but I can go in and have it scrub tick data back 6 days. And that's a lot of computing power, but typically it'll scrub up to 1 minute. And I know that seems a bit much, but as many of our clients, my colleagues, and certainly a lot of Auvorians know, I have a raging case of OCD when it comes to detail and quality of data coming into all my technical analysis systems. It's got to be quality data. And that's why I didn't jump on board with TradingView in the beginning, because I just didn't trust the data coming in. It's got to be quality and without errors, especially in the futures markets. Or all of my analysis stuff is going to be skewed, right? So there's risk management right there for you. Spiders, we had a little bit of a pullback. Looks like we're probably going to take another run for the high. We're in a seasonal Q4 period historically, at least the last 12 years, probably a bigger argument the last 30 years. You've had, in good times, even though we got a whole bunch of inflation, generally coming out of a pandemic, I guess we would somewhat consider this to be much better times than the last 2 years, right? So good times typically takes markets up into the end of Q4. Some adjustments take place in October, as I'd mentioned, with a lot of funds that will reset and or have a fiscal year that ends October 31st, like a lot of mutual funds and ETFs in this country. It's not a calendar year end. So whereas once they get all their sort of portfolios reset and positions built, you typically have what's called melt up into the Santa Claus rally. So, I would not have been against that. I've told everybody to just sort of ride this up if you're just trading over any kind of swing. It's a little tougher with markets from the standpoint of intraday. We're looking at a 4-hour and hourly chart. You have stair steps up in many cases with a lot of these chart patterns and elevators down, right? And a lot of it has to do with sort of that bubblicious place that we've in. Just note that, and I would say we're talking a lot about this stuff in our letter from the standpoint of historical comparisons. The movements in equities, and I guess you could certainly argue other markets, have been in stark contrast to what has happened in previous decades or other periods of time other than the last 12 years, when central banks have said things like, we're going to be tapering or we're going to be more hawkish, and essentially pulling assets and putting them back on the marketplace, right? Pulling cash back into our reserves. Markets have looked very negatively on that well in advance of it actually happening. And we haven't seen any of that recently. So, maybe I'm wrong and we continue moving up into the end of the year. I kind of see that as necessarily being wrong, but I think all bets are off come January 1st, right? And, the idiots in DC with policy making, both sides can be blamed for this, are doing nothing but just putting us in more debt, right? And they'll have their talking points on good pieces and bad piece, pros and cons, essentially, of legislation. I'm not addressing any of that because we don't really have any color on what eventually it's going to look like and how it's going to affect it. But there's a lot of negative programs in almost every bill that comes out. So one should certainly expect that from their regulators. But just of note, if you look at just a 4-hour chart, point of control, where notice we can't get over it. See that? So again, it continues, in this point of control is up near the top of the value area high of this area. I have not the sort of best locked data set coming in, but I've got the whole period of time. But it's interesting how it's really contained us recently. We even poked our head above it and couldn't get any traction, at least on the 1-hour chart. So I think that certainly argues for going back and maybe testing some of these lower lows first before a rip higher. Just a thought. Could be wrong. So, wish everybody a great week. Remember, you can learn a lot from failure. Some of the smartest people on this planet have failed over and over again. And they came back and they were successful. So let your hearts not be troubled in that area. Wish everybody a great weekend. I recommend partying heavily, as I will try and do tonight. And may the trades be with you.